Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, glad to have you back with us today. We've been talking about the stock market and how I think God put that on the shelf for his people. And it's such an amazing amount of information out there and so many things that Wall Street has done. And of course, they did it to make money for themselves. But I think God had us in mind because these things are so amazingly useful. We can even use the concept for building a family stock trading business, teaching our kids and the grandkids the skill sets. And then we have the potential to create generational wealth. And it's so cool. You know what? You may not realize this. You know how much it costs to start a brokerage account? Nothing. It's free. You just sign up and make application and boom, you've got a brokerage account. I mean, you can use any brokerage account like TD Ameritrade or eOption or Tastyworks. You can use any of these online trading folks and it's just free. And make sure when you sign up for it, that you just realize you don't have to go out and dig up all your statements and so forth. You can just sort of round your figures off. Like you're going to have to tell them what your approximate net worth is, what you make approximately every month, but those can be estimates. So you don't need to go do a lot of homework. Just estimate it. Don't lie, but at the same time, estimates are great and they know you're doing that anyway. So it's not that hard to fill out, and make sure when you do it that you sign a margin agreement. And really what that's going to be is the coolest ability to get a loan from a bank you ever had. I mean, you don't really just fill that thing out and boom, you've got it. And I'm going to show you how you use that in a minute to leverage your money. It may sound bad to some of you guys. If you've listened to Dave Ramsey, I love him. He's talking about don't use debt to buy toys. But there's nothing wrong in God's word with using debt to buy an asset that creates cash flow for your family. That's what God created debt for. So I'm going to talk to you a little bit about that in a minute too. So what we've been talking about, if you want to catch some of the earlier episodes, is we talked about a bit of money management where we advocate that you never use more than about 20% of your total money or total assets to trade. And I'm talking about shorter term trades. Could be 10%, 15, but never more than 20. So you got about 80 to 85% of your total money that's out there in something safe, that's more diversified. Our company has a division called AMPT, A-M-P-T, and we help you with your retirement funds if you're interested in that, but that's what that's for. But today we're talking about the shorter term trading, and you'll never use, well, at least we advocate you not use more than about 20% of your money. So now that presents an interesting problem. You're going to trade with a relatively small amount of money. So if that's true, we need to be able to leverage that. How could we have the potential to make money faster? And how could we do that? Well, we mentioned in the last show, there's two ways, margin and option. So I want to go into more detail on that and even give you some examples. So we're going to have to use our imaginations now because you got to picture some things in your mind as we talk about this. But let's talk about margin first. Now, remember a moment ago, I said when you fill out the application for your brokerage account, you want to make sure you fill out a margin agreement, all right? And then you'll have a margin agreement. And remember in a recent show, we talked about how you can actually literally have a garage sale and raise $1,500 or something like that. I think $2,000 is the magic number if you want a margin account. So let's say we raise $2,000 in our garage sale, and then you've already got your account open, so you just wire that straight from your bank account to your new brokerage account. And remember, because of the laws since 9/11 and so forth, you have to make sure you're sending it from a bank that has your name on the account, just like the brokerage account has your name. It has to have the same name or it won't work. So you're going to transfer money from your regular bank account then where you put your garage sale money. You're going to transfer that into your brokerage account, and now you've got a couple of $1,000s to trade with, and it's not using up any of your retirement money. You're not putting anything like that at risk. So that's how we like to see you start. Then you can paper trade with no risk because you don't use real money. You use monopoly money for that. And then you can do what we call the small money trading. And $2,000 probably is small money trading for a lot of you guys. So you can use that, or you could just use 500 of it if you wanted to. But I'm going to show you how, because you're using a relatively small amount of money, how could we have the potential to turn that into a relatively large amount of money in a relatively short amount of time? That's what we want to talk about. Well, you have to get leverage. Now, if you want to know where that concept comes from, you can go back, review a recent episode where we talked about how the Bible is full of business concept, economics, finance, small business, family business concept, large business concepts. All of those are in the Bible. But in the parable of the talent, it talks about a concept called financial leverage. And that's what you have to gain. And so you gain that through getting leverage. How do we do that? We need to make our dollars worth more. So what if we could have every dollar that's in that brokerage account? We use the example of $2,000. What if we could double that? For example, what if we could buy $2,000? Let's say we had $2,000 in there. What if we could buy $4,000 worth of stock with that? Well, that's exactly what a margin account allows you to do. So you can make it where every dollar's worth $2. Now, what's cool about it, when we're done with this, we're going to talk about options. That's huge leverage, because with options, every dollar can be worth from $7 to $14. And I'll show you that when we get to it, but it's really exciting. And to be honest, the world is set up where we're not even supposed to know that. Middle-class America is not even supposed to know this. Wall Street knows how to do it, but you're not supposed to know how to do it. So I think God put this on the shelf for us. So we're going to show you how to do it. So let's talk about margin. All right, well, I'm going to use some examples here. You got to use your imagination to picture some things. I even want you to picture a chart. And if you don't know what that is, check out some of the earlier episodes where we talked about technical analysis and charting. A chart basically just takes the price points of the stock, usually at the close of each day, and then connects the dots. They make some really interesting patterns, and we can teach you at TRADEway, we can teach you all the patterns that work today where they're pretty predictable. I mean, you can't predict the future, but it's all about probability math. So if you see it making a pattern the last month or so, it's likely to keep doing it for a while. And that's the kind of math the big boys use, and that's what we teach you to do. Let's take a look at this particular stock. It's called Acasti Pharma, Inc. So this is a little pharmaceutical company. It's a pretty new company, a little growth company, and the ticker symbol is ACST. And you would find this if you're an insider with our company. We provide you a couple of cool baskets of stocks where the fundamentals have already been checked for you. One of them is called the less than $30 per share list, and this one is in that list. And then there's one called the A+ list with higher than $30 stocks. And that list has the best growth companies in the world. And we provide those for you if you're an insider. So check out the insider program when you get an opportunity with TRADEway. But anyway, I pulled this one right out of that list. And remember now, these are academic examples because this example is a trade that goes back to about October 3rd of 2019. So obviously this exact trade's not available now, but there are other opportunities all the time. Now, at that time, if you could look at the chart of ACST, you would see that between September and about the end of December of 2019, it made what we call a pretty little rolling pattern. And so that stock was rolling between about $1.85 a share up to about $2.20 to $2.25 per share. Now, see, that's a cheap little stock. What's cool about that is you can get more shares. And I'm going to take an example, the exact example of the garage sale, and we raised $2,000. And I'm only going to need to use about $1,850 of my money. So I'm not even going to use it all. And we're going to be able to buy 1,000 shares for that. So if the stock is at $1.85, multiply that by 1,000, that's how many shares we're going to purchase. That'll cost you $1,850. So that's how we're going to enter the trade. Now, before I talk to you about this little rolling stock pattern, which, by the way, if you want to really get good at these, go out to TRADEway.com and look for an event called Step 1 Start Your Journey. It's a 2-day event. Sign up for that. It is fantastic, and you'll learn about this particular pattern, the rolling stock pattern. It's awesome. You can do it right there from home, and you're going to start picking up these things. And so what I want to do before we talk about trading in that fashion is let's talk about what most people know how to do and what really Wall Street and the whole world wants you to know how to do, and that is called buy and hold. And I'm going to give you an example of this play doing the buy and hold method, which is what everybody talks about. Even if you went to the MBA program, got a business degree, they're only going to teach you how to buy and hold. I learned how to trade from my grandfather, and that's been passed down through our family now to the fifth generation, going into the sixth generation, these skill sets. And we've been going around the country for about 15 years now, teaching these skill sets to brothers and sisters in Christ around the country. It's been awesome. But anyway, so first let's do the buy and hold example. So here we've got ACST. We're going to buy 1,000 shares. And we're going to do the buy and hold, and it's at $1.85 per share. So 1,000 times $1.85 is equal $1,850. Now remember, we raised $2,000 at our garage sale, right? So we can buy that much. So now we've got 1,000 shares at $1.85. And we're going to hold this for about 2 months and 15 days because that's the length of the example of the rolling stock we're going to do in a minute. Now, normally buy and holders might hold it for a year or two, who knows? But I'm trying to make this apples and apples. So let's do the same length of time and the same exact investment. So we're investing $1,850. Now, wouldn't you agree that's the risk we're taking? I mean, the most we could lose on this play is what we put in it, which is $1,850. Now, remember, if you're a buy and holder, you probably don't know anything about trading, so you might lose it all, right? But if you know rolling stocks from TRADEway, from our method, you would stop it out if the play went down instead of going up, and you might lose 8% of your total investment. So you might lose 8% of your investment, your $1,850. That'd be about $148. So you would still have $1,650 left to do another trade and make that back. So that's what you would really do, is you would stop it out if it went the wrong way. So you're not going to lose your whole investment unless you don't keep rules and so forth. But if you're a buy and holder, you don't know to stop it out, so you could easily lose it all. But let's just say that you bought it at $1.85 on October 3rd, 2019. So that's $1,850 investment. And let's say we sell it out there about 2 months and 15 days later on December 17th, 2019. And by then the stock had moved up from $1.85 to $2.40. So we actually made a $550 profit doing it buy and hold, assuming that's when we sold it. Now that would be a 30% return. Listen, that's not bad. That's probably better than your financial advisor made on all your money last year. But remember, this is not diversified. So sometimes you make a little bit higher returns when you don't diversify because it's not as safe, theoretically, right? But this is just an example, academic example. So keep that in mind. Okay, so now with buy and hold, we put $1,850 at risk. We bought 1,000 shares. That cost us $1,850. The stock moved up to $2.40. And we sold that same 1,000 shares for $2,400. So we made a $550 profit. Pretty cool, right? But now it's not so cool when you stop and look what you could do if you had the knowledge. Now, what does the Bible say? The Bible says knowledge and understanding and wisdom is better than gold. It's better than fine rubies. Why is that? Because the world can take your gold away, but it can't take what's between your ears away, your knowledge and understanding. And if it did take your gold away, you can make it back when you have knowledge and understanding, and skill sets is the modern term for that. So at TRADEway, we teach you that Wall Street wants you to think stock trading is brain surgery or rocket science. It's actually just skill sets, and we teach you those skill sets. So let's do this same play now with a rolling stock. So what I want you to picture is, in fact, if you know how to do charting, you can go back and look at ACST on a chart. In fact, you can go out to Google or Yahoo Finance, and they have free charts. You could type the ticker symbol ACST in there and see that if you did a daily chart, you can see it rolling. If you go back to September through about December of 2019, it just rolls up and down. It bounces up off of about $1.85. And it rolls up to about $2.20, $2.25, and then it bounces down. It goes back down to $1.85. And it takes about 2 weeks for it to move up, and then about 2 more weeks for it to move back down. So in 1 month, at 30 days, it goes up and down one time. And that's kind of how it looks, if you can picture that. It goes straight sideways with this pretty little wave or roll. And so now what we want to do with the rolling stock method, instead of buying it and holding it, we're going to buy it on the same date, October 3rd, 2019, 1,000 shares at $1.85. That's still the same investment, $1,850. So what's the most we could lose on this play? What we put in it, $1,850. But would we lose it all? No, because if it went the wrong way, we're going to stop it out and lose maybe $150 and then keep going and make that money back. So that's the idea, is we manage the risk, you see. So, all right, so let's buy 1,000 shares. So we invest $1,850 on October 3rd. Now, in 2 weeks, really this happened within about a week, because on October 19th, all of a sudden it had rolled up to where the stock is at 220. Now, we teach you how to draw lines across those bottoms, and we call that the support line. And then there will be a parallel line across the tops, the highs of those stocks, where the little roll hits the high. That would be called resistance. And what stocks tend to do is they'll bounce up off support and go up until they hit that resistance line. They tend to bounce back down. And that's what this one is doing. It's so clear to see when you see these things. And you can find them. I mean, I probably looked at about 25 stocks on my charting software to find this little roll. And I've got a couple more examples I'm going to give you. So I found 3 beautiful rolling stocks out of about maybe 50 stocks I looked at. So they're out there, and you have these opportunities. All right. So here's what we're going to do differently. When this thing rolls up and hits our resistance line, which is right around $2.25, I'm going to sell it. I'm not going to buy it and hold it. I'm going to sell it every time it gets close to resistance. Now, why am I doing that? Because the big boys on Wall Street, the guys that are making this thing roll, the guys that have done all the research on this little stock and putting millions of shares into it, they tend to sell when it hits resistance, and that's what drives it back down. Why? Because they can make money when the stock's going down. You can too once you learn some skill sets, but not yet. So we'll talk about that later. But that's called shorting stocks. We don't want to go there yet, but they can do it. And that's why they make these things roll up and down. It doesn't take but 2 or 3 big boys to control the direction of a stock in most cases. And we teach you all about that in Step 1, Start Your Journey, or even I think we talk about it in the Trade in 30 Days Challenge about what makes the charting work. It's 2 or 3 big boys that are controlling a particular stock. All right, so it goes up and it hits 220. Now, I'm going to tell you one other little thing that you'll learn when you come in and learn the details of how to do this strategy. I like to take that resistance line and ooch a second line just a little bit down from it. And there's no percentage. I just eyeball it on the chart. I just move it down a little bit. And I like to take the support line and pop a second one in slightly higher, just a little bit higher. And then I'll trade between those 2 trading lines. And the reason I do that is because I want to get into the stock after the big boys get in it. And they tend to jump in at support. So I want to get in just a little bit after they do. And then I'm going to jump out before it gets to resistance, because that's when they get out, and I want to already be out of the play. If you're having trouble picturing what support and resistance lines look like and what they mean, let me give you an example. Okay, so to picture the support and resistance lines, the support line is just the bottom line where the stock tends to hit it and then bounce up. And the resistance line is the top line where it tends to go up and hit that one and then turn and head back down. So you can label it on your paper, the bottom line, put a little arrow and call that support, and the top line, call it resistance. Listen, the big boys use this all the time, so that's why we do it. Now, another thing you could do is take your ruler and just go up just a little bit, just ooch it up a little from the bottom line and draw a dotted line parallel to it, and then go up to the top line and come down a little bit and draw a dotted line. Now, those dotted lines are what we call trading lines. And I trade between those because, remember, I want to get in after the big boys get in. I want to get out before they get out. And if you trade at those trading lines, it'll make that happen for you. It's a really cool system. So let's do it that way. So let's go back to our example of this actual stock. Now, remember, it's academic because this happened in the past. It was about October 3rd, 2019 when this thing was rolling so pretty. Ticker symbol ACST. So we jumped in at $1.85. Now we're going to do the rolling stock pattern this time. So it's 1,850 because that's $1.85 times 1,000 shares, right? And that thing just in about a little over a week, by October 19th, it had rolled up and hit our dotted line at $2.20. So we sell it. So you can make columns if you want to. It makes this real easy. You can just put a column where you put the buy and sell numbers, the total amount you buy it for, the total amount you sell it. in a column. And then to the right of that, we would just simply create a profit column, and we would subtract 1,850, which is what we bought it for, from what we made, which was 2,200. It's not what we made. That's what they put back in the account. Subtract those two, and it gives you what we made. That's the profit, and that's $350. All right. Now, what's cool is that is about a 19% return. So we've made almost 20% with just one roll. And remember, the buy and holder only made 30% on the whole play. And we're just now started. So now what we do is, if you look at your picture you drew, you're going to let it roll back down and do nothing. You just leave that money in the bank, $350 profit. So now you actually have $2,200 in the bank because you started with $1,850 and you made $350. So now you have $2,200 to trade with on the next roll. So guess what? We're going to buy more shares on the next roll. So we just sit and wait for it to roll back down and hit your support line and bounce up a little bit. And it does that on 10/30/2019. Now we can afford 1,190 shares instead of only 1,000. Now I want you to notice something. That's another form of leverage, isn't it? So we're able to buy more shares because we're using all the money in this particular play, putting it back into the next roll. When you do the buy and hold, you don't get that leverage because you're stuck at 1,000 shares the whole play. So now we buy 1,190 shares for $1.84. That costs us $2,190. Well, we've got 2,200, so we can afford that. And we wait for it to roll back up. And on November 5th, sure enough, it rolls back up. We sell it for $2.10 a share. That's another $309 profit. Okay, so we wait for it to roll back down. And then sure enough, on 11/12, it hits support, bounces up a little bit. And now we can afford more shares because we just made more money. So now we're going to buy 1,220 shares at $2 a share. That's $2,440, isn't it? Let it roll up, and it just takes one day on this particular roll. It's amazing. The next day it went all the way up and hit resistance. So on November 13th, we sell our 1,220 shares for $2.26 a share, and we make another $317. Now see, so far in our profit column, we've got 350, 309, and 317. Just put them in a straight line there. We're going to add them up in a minute. All right, so now we let it roll back down. And sure enough, on 11/14, it rolls back down. Now we can afford 1,300 shares at $2.10, and we buy those for $2,730. All right, it rolls back up by the 19th of November to $2.25. We sell it for $2,925, and we made $195. All right, so now we let it roll back down again, and then on December 3rd, we can buy more shares this time because we've made extra money. So we buy 1,535 shares at $1.90. That's $2,917 is what the cost of this roll is. It rolls up by the 17th of December to $2.40. We sell our 1,535 shares for $2.40. That's a $3,684 gain. So subtract that from 2009-17, you get a profit of $768. So now we've got $350 profit on the first roll, $309 on the second roll, $317 on the third, $195 on the fourth, and $716 on the fifth. Why do we make so much more? Because we've been leveraging and buying more and more shares. You add down there and you get $1,939 for the whole play. Now remember, we made $550 buying, holding, or 30%. But by playing every roll, we made almost $2,000 profit. So we practically doubled. We actually did double our money. We more than doubled it. We made 105% return on that. You only made 30% return buying and holding. So which would you rather have, 30% return or 105% return? Pretty easy to answer that one, isn't it? Now think about this. Sometimes we do a thing called annualizing the return. And this is to be able to compare apples and apples if you're doing 3 or 4 plays at a time so you can see which one did the best. It's not because we think it really works this way in the real world, but if you assumed that you did this same play all year, every 2 month and 15 days, every 2.5 months, you were able to do this play or a similar rolling stock. It wouldn't even have to be the same ticker symbol. It could be a different rolling stock, but you got similar results and you did that every 2.5 months all year, your return would be about 510% return. Now think about that. And I'm not saying you can do one of these every single couple of weeks all year, because there's going to be times when you shouldn't trade. We call that a squirrel market. There's going to be times when maybe you don't find a rolling stock. But if you had this knowledge, you had the potential to make 510% on your $2,000 investment or your $1,850 investment. And well, what if you only found them half the time? That would still be what, 260% return if you only found half the time you did them? That's still better than 30%, isn't it? So it's see, this is power. Knowledge and understanding has now given you power and potential to change your family's life. And this is just one of about 45 strategies our company teaches. We're about to run out of time here, so we'll just leave this example. But what I'd like to do in our next show is take another example. But before we leave, I want you to think about this. Okay, so here's what we did. We went out and we opened a trading account for nothing. Let's say at TD Ameritrade. Cost us nothing. And we made sure that we did the margin agreement with it. And our staff will help you with all that when it comes time for you to do this. But anyway, you then had a garage sale and you made $2,000. So you wired that from your checking account into your brokerage account, right? Then we found this beautiful play, ACST, on October 3rd, and we invested $1,850. And that was almost the $2,000 that we had, right? And we did the roll all the way down until December 17th, and it rolled 1, 2, 3, 4, 5 times, and we made $1,939 profit. So we doubled our money, more than doubled the money. But now, wait a minute. We talked about a thing called margin. So think about this. We had $2,000 in the account. We actually could have bought 2,000 shares instead of 1,000 because they'll let you buy on margin. So we could have bought 2,000 shares and then done the same play, buying and selling the 2,000 shares, starting with 2,000 instead of 1,000. Of course, it would increase each time because as you make money, you can buy maybe 2,020 the next time, maybe 2,040 the next time, maybe 2,090 and so on throughout this same play like we did. It's just that we're starting with twice as many shares because we bought half of them on margin. Guess what that would do for your results? Instead of making roughly $2,000 profit, you'd make $4,000. It would double your profit. And instead of making 105% return, you'd make 210% return using the margin with the same amount of money in your account. So what we've done is we have made every dollar worth $2. That's called leverage. And that's one of the great keys we want to do when we're using a relatively small amount of money to try to create a relatively large amount of money in a relatively short amount of time. So the first trick is margin. Next show, we'll do another example, but then we're going to go into options because then all of a sudden you can make a dollar worth $7 or maybe $14. And that is powerful. So we'll go there next time. So we sure had fun with you guys this time. If you had a great time, be sure you rate and review this episode so people that think like we do will find us. And also remember to go out to TRADEway.com and sign up for our 2-day event called Step 1 Start Your Journey. And it's awesome. You can do it from home. You can do it on the internet. And you have the potential to really begin to be expert at these great strategies. All right. We'll see you next time.